Advisors, Tom Lee, joins us here at Post 9. And I invoked your name yesterday, Tom, because I said even the bullish Tom Lee said that the January rally borrowed from February. So you're still expecting a tough, few weeks here, months? What's your time frame?
Yeah, I think investors should expect some payback. I mean, we had one of the best ever Januaries, and if you look at the 7 years that mirrored what we just saw, it's going to be tough in the second half of February to early March. But it doesn't mean the full year. I think there's no thesis change. I think this year is still going to be a story about how inflation cooling makes the Fed data dependent, not data reactive. And that means volatility is expected to fall both for yields and for equity risk premia, and that's why stocks can rally.
So I'll just play devil's advocate on the inflation thing. The market has been so focused on inflation because the Fed has been so focused on inflation, and the Fed is not convinced that we've seen a sustainable decrease in the inflation rate. So why wouldn't the market sell off every time there's evidence that inflation is harder to squash?
I mean, I think that's kind of what happened in the last couple of weeks. Everyone saw January data a little hotter, and they think the Fed's going to jump on that. But prior to that, we have to keep in mind we had 3 good inflation prints. Powell invoked the word disinflation 13 times in his press conference. We get the minutes today, and if we see more comments than that in the meeting, I think it allays fears that the Fed...
But that's old news. Since then, we have seen evidence that it might not be so disinflationary.
But the economy doesn't pivot. So when people say if inflation's flaring up, I mean, that's assuming the economy hinges on like a matchstick. And, I think there were a lot of January seasonals affecting that. And at the end of the day, gasoline's already rolling over, and if natural gas is tanking, and Carl pointed out lithium's tanking, and housing continues to weaken. I mean, both sides of the inflation story are, and that's over 60% of core, is deflating.
And you've pointed out shelter obviously lags the most.
Yes.
And if that really does, say, react with a 12-month lag, then this summer is going to be, we all got disinflation without it. What's disinflation going to be like with it?
Yeah, that's right. Let's say that the 60% of core is either 0 or negative, including housing going negative. You can't even get 2% inflation with the other 40%. So, I mean, I think you might be printing 2% inflation starting in the summer.
You made the point that a tough Fed doesn't mean the stocks have to go down with every inflationary data point. You point back to Volcker or even Arthur Burns, I think. But, a transition like the one that we're in the midst of, from the zero bound to wherever we're going to end up at a terminal rate, is there anything that isn't, can you really make that connection to that period in the 70s?
Yeah, I mean, we just published a piece on this that if you look at the 14 rate cycles that lasted more than 12 months, 11 out of the 14 markets rallied into highs with the hikes. The 2 exceptions were during Burns, when he was higher in a hurry. But actually, once Volcker became Fed chair, believe it or not, hikes were associated with higher stock prices. And of course, in Greenspan, there were 5 cycles of his raising. 5 of 5 times markets marched higher to all-time highs. So unless Powell is invoking Burns, I think the stock market is going to appreciate data dependence. I know people talk about equity risk premia is at an all-time low, but that's because inflation risk premia is at an all-time high. That's what's embedded in interest rates. So if inflation risk falls, yields will fall, and equity risk premium is actually going to jump. So
unless we have a deeper economic recession or any economic recession, right? And then an earnings recession, which a lot of folks say is not priced in.
That's right. I mean, the recession calls started last January, so investors and even CEOs priced in a recession last year. We saw it in a lot of the earnings calls. So if a slowdown happens, a lot of it's already been positioned. I mean, I don't know if you call it a rolling recession or a no landing, but I think a lot lot of the bad news is priced in.
You getting beat up at all by your clients? Has this been a rough period?
Yeah.
Every day?
Every day. I think the good news is that market internals are forcefully arguing our view that markets will make an all-time high this year. Mark Newton's written a lot about it. And here's an interesting stat. On January 12th, 2023, something happened that has never happened in 70 years of market history, which is you had 3 measures of market breadth actually become 5 standard deviations. You had like a Walter Deemer breakaway momentum move, a Whaley breadth thrust, and then this 3 days of consecutive up volume. And the last 8 times that were close, markets were higher 12 or 12 times. So that's why the internals, I think, are arguing 20% gains.
Oh, Whaley
Whaley breast thrust.
Well, yeah.
Thank you, Mike
not
Whaley.
breast thrust, breath thrust.
The technicians are creative. What can
yeah,
I
I
say?
guess. Even Sarah didn't know that one.
I did not. Tom, thank you.
Thank you.
Learned something. Tom Lee.
Got a little wonky there. Going to check on the top.